Finding deals. What I want to do is we learn how to quickly assess an initial deal. Like, how do we actually look at a deal and go, all right, let me have a quick look at this. Is this something that will fit? Number one, what's the most important thing we're going to consider when we're looking at a deal? Vision. Align with your vision. That's right. Number two might be location. Number three is going to be what industry is it in and how affected that can be by, potentially a recession or something like that. Like, you've got to take those other things into account. But there needs to be a quick way to actually assess a deal and research a deal. This is the little sheet that I created for initially assessing a acquisition. To me, this is basically what we need to know to get a snapshot. It's a one-pager or a cheat sheet, if you want to call it that. So if you were to get on the phone and ring a broker, you can effectively ask most of these questions, or at least get most of that, and then research a bit further to get a few more things. So obviously, what's the name of the company if you know it? Because if you do know it, you may be able to ring up and speak to the owner directly, which I would have done also, but I also would not have cut the broker out eventually. Industry, what industry is it in? What location is it? If you have an address, that helps. And then having a look. Usually you'll get a couple of years worth of numbers to look at pretty early on in the piece when you do an inquiry or something like that. Gives you a bit of an idea, what's the average? So straight away you're going to see what's the trend doing, is it going up? So in this case, is revenue going up and down? Is profit going up and down? And if they're disproportional, why? So how come revenue went up at 400 grand, but profit went up 10? What the hell's going on, right? Something's not right. So straight away you can see from the numbers, and I'm starting with numbers on purpose, is because that number is going to throw some red flags. Now the other thing that you need to be aware of is the more deals you look at, the faster you're going to be able to assess a deal. Right, because you will go, no, out very quickly. When I was doing corporate finance, I looked at about 250 deals in 2 years and invested in 5 because the others weren't worth it. The others either, you'd get something, okay, we've got a 20-minute time to talk, and then up comes a slideshow on Zoom, whatever, and they're like, right. And then I'm looking at the bottom going, we're 10 minutes in. Hang on, guys, is this slide 5 of 96 slides? Is that correct, that number? And we're 10 minutes into a 20-minute thing. And they're like, yep. I said, well, if you can't get your presentation in 20 minutes, then I'm not going to talk to you because clearly you can't sell it. So out of 250 deals, probably 10 of them looked at, 5 of them invested in some way, shape or form, right? Because the rest were predominantly shit. That's how it was. Someone would just literally had someone try and do the whole draw it on a napkin thing. That's when I stopped saying yes when people said, do you want to go get a coffee? And realised that they're just doing this. Leeching, try and get more information out of you. That's all they're doing, right? So I got down to about 5 minutes max to look at a deal, to then go whether I bother going to the next step or not. So if, for example, you have no interest in a certain industry, then that's going to give you a no immediately. You're not even going to have to go through this process. But if it is, start looking at it. So let's look at what are their assets, right? Do they have any current liabilities on those assets? If you have a look at the balance sheets, it'll show you what's their current debt. And if it's a clear balance sheet, it'll tell you what the debt's for. If it's an unclear balance sheet, which is probably the majority of the time, you're going to have to ask, what is all this debt? What's this debt against? Just to get an idea. Now, we don't want to buy debt. If that business had $1 million debt and you're buying it for $2 million, that debt is to be paid off as part of the sale, as a condition of the sale. Because what happens if there's some little issue in the agreement or something and you buy the business and they're like, no, I'm going to keep that debt and I'm going to keep servicing it, but it's somehow tied back to the business, now becomes your responsibility. No. You've got to pay the debt off, give them the net amount. What's the asking price? And then work out the multiple of that. So now that you have an idea of the average profit, if they're asking $1 million, profit average is 200 grand, they're asking a 5 times multiple. And if it's a sandwich shop next to a train station, it's probably not worth 5 times profit. How old's the business? How long's it been running for? What's the size of the team? Is this business a competitor, complementary, or other? Is the owner looking to exit immediately, which is walk in, walk out, which means that you have to walk in and they walk out? In most cases, I would suggest not to buy a business like that, unless you have an already existing structure in place and potentially an existing business in that industry where you don't actually need to walk in to run it. You can buy that business, that person leaves, and you plug that business into your existing other businesses. So particularly if you're pooling businesses in the same industry and bringing business A, B, C, and D together, there's commonality across all of them. You don't need someone to manage that one business when you've already got someone managing the other 3. They can now start to manage that business. But with a walk-in, walk-out business, you'll pay a lower multiple because it's higher risk, okay? But it's higher risk if I was buying one. If I've already bought 3, My risk's probably much the same as whether they stay there or not, right? As an investor. Does that make sense? But I'm not going to pay them based on the fact that my risk is lower. I'm going to pay them because they're walking out. So therefore, it might be a 1 times multiple. It might be a 0.8 times multiple because there's massive risk with them just walking out the door that the wheels could fall off. Reason for selling. This is one of my favourites. If the reason for selling is they desperately need the cash, you can ratchet the price down because there's a level of urgency and they then need it done quick. That's still a fair and equitable value exchange because you're solving their problem. They need it done quick. You can do it quick. Therefore, there's going to be a discount on the price.